Next question.
Mr Chairman, I'd like to reintroduce Michael Sanderson.
Hi.
Hello again. This goes to interest rate increases. Matt Common, CEO of the CBA, at the recent AGM confirmed, and I quote, "We also create deposits in the system. We expand money supply when we lend money." End of quote.
That's true.
Banks effectively have got a magic money tree.
That's true.
Please consider the following scenario. Fred Nurk purchased a house from Joe Bloggs. Both banked with Westpac. It was an in-house transaction. There was no overnight money market involved. Westpac extended a mortgage secured by the house and Fred Nurk's personal guarantee. Westpac created a deposit and in doing so expanded money supply in order to facilitate the loan to Fred Nurk. Ceteris paribus, that is, all other things being equal, my questions are, how does Westpac, and by extension other banks, justify increasing the interest rate on Fred Nurk's and other mortgage or loans in line with the cash rate when the cost of funds was zero? Is this profit gouging? Perhaps it's subsidising other products where the magic money tree can't be used, or both.
I'm not sure technically you're correct, but I'm going to ask Peter to answer the question.
Well, it's a hypothetical, Mr. Sanders, and it's interesting, but from our perspective, what we're doing at the moment is reflecting the cost of the RBA increases in rates in mortgage rates.
That's exactly right, but the cost of funds is zero. The public perception is that you lend depositors funds or you borrow on the money market.
Correct.
In this scenario, which is common with lending, you are increasing the money supply to facilitate the loan. How can a bank justify increasing the interest rate on that loan, where the cost of funds are zero, in line with the cash rate?
So the cost of funds at the moment is not zero. On a deposit rate at the moment, we're paying 3.5% for the Westpac Live, including the behaviour benefit.
But
so it's not zero.
You're not lending those funds. You've created.
Yes, we are. That's why I say it's a hypothetical. If I look at the cost of funds are not zero at the moment.
So you're saying that Matt Common is wrong?
No, I don't know what Matt was referring to, and I'm not going to comment on...
Matt was referring to increasing the money supply to facilitate lending.
Yeah.
This is horizontal money. Banks create horizontal money, the government produces vertical money.
It's not technically correct. I mean, the business we're in is taking deposits and or money from the market and lending it at a higher rate, and the difference minus our costs, minus the losses, gives us the return on the capital that's invested, and we've got to generate a minimum return of 9%. So that number has to be higher than this number for that equation to work. And that is the nature of banking, as well as providing other services that produce the return. So I'm sure you want us to make the money in order to produce the return, in order to pay the dividends. So, and that's the nature of business.
Merely trying to understand, how a loan works. As I say, we've got a lot of sidestepping and what have you, but as I said, I've attempted to produce a scenario that's simple, to take out the complexity based on what another CEO has said. But anyway, we'll leave it at that.
The only way we create money is to borrow it from somewhere and leverage it up. But a deposit funds a loan, and an asset, a liability, that's it.
Let me put it another way. So what you're saying is everything that Westpac lends comes from depositors' deposit or money that is borrowed on the market?
No, it comes from capital plus deposits plus borrowings.
So Westpac does not create or increase the money supply in the process of lending under any circumstances. Is that correct?
Well, here, start with an asset,
No.
and then the question is you've got to finance it, okay? We finance it by raising equity from you.
No, you're missing the point.
No.
Well, all I'm asking is, and the answer may be yes, that's what
No.
we do. Does Westpac increase the money supply in the process of lending? Is there any scenario or...
Well, there's the multiplier effect where you do. You know, as house prices go up and we lend against the house prices, effectively the value of money, if you want to call it that, goes up in the economy. So that's one way. But I just think, you know, a hypothetical example like that is not as complex as the bank.
But credit increases the money supply if you're looking for that answer.
Yeah.
Of course it does.
So what's the cost of that credit?
Well, M3 includes credit.
All right, we're not getting... I'll analyse the answer.